Hi, and welcome to the Founder's Journey podcast. I'm Greg Moran, my co-host Peter Dean. Good to see you, Peter.
Good to see you. Thanks for having me back again.
We go through this every episode where Peter is shocked that he's returned yet again for another.
I'm still allowed to talk here. So excited about that.
That's right. So just as a reminder, Founder's Journey podcast really is meant to provide coaching and actionable tips for founders from founders. So if you're not subscribed, I hope you take a second and do that right after this recording, or put it on pause and do it. I think it's somewhere on the screen. Anyway, we've got a great founder with us today that I've gotten the real pleasure of getting to know over the past several months. Alex Banks is our guest today. Alex is the founder of the Through the Noise. Through the Noise, which is essentially a media brand. I think you could probably call it a conglomerate at this point, right, Alex? Focused on delivering high signal information for business, finance, and growth. He's a real prolific online creator on Twitter and a number of other channels. And we'll let Alex give you the pitch on Through the Noise. But Alex, welcome.
Greg, it's a real pleasure. And Peter, thank you so much for having me today. I'm thrilled to be here and really excited to dive into this conversation.
Yeah, no, likewise. Glad to have you. So, just as we get started, tell us, just tell us a little bit about yourself. And I gave the 6-word description of Through the Noise, but you're going to do it a lot better justice than I did.
Sure. I guess I'll start with a little bit sort of on me, and then we can branch off into Through the Noise. But I guess from a high level, I've been building online as a creator now for the last 5 months, really. My aim is to help educate and really demystify business, finance, community, and growth for those who want to do the same as me, only quicker by sharing what I do along the way. I think creating in the first instance was something that I put off for a while. I guess coming from the sphere of traditional finance, corporate finance, investment banking, I was immersing myself in a very closed, very hush-hush and tight-knit group of individuals who didn't really have an inclination to share ideas outside of their realm, when actually what I understood now is if you really want to control the outcome of your life and control your brand, that's really the only way to gain tremendous leverage and tremendous ownership of at least how you direct your own future. So I guess it was something that I really held back for a few years. I was in the first instant worried about, falling over, bumping my head, grazing my knee, and, was I going to write the wrong thing here, or was I going to say something stupid there? I think I was, heavily hit with imposter syndrome, Greg and Peter. But I think, it's Ray Dalio, the great investor. He says, look, we fail to learn principles, we improve, and then we set these more audacious goals to go after, right? So I guess by failing fast, we learn to quickly speed up and get a real hang of the process. So that's really me from a creator standpoint. And then back at the start of April, I was writing quite a few threads on sort of finance and venture capital and how those two spheres intersect. And I thought, look, I'm spending a good amount of time on Twitter each day, and I can see that there is one heck of a load of noise on my Twitter feed, not just Twitter, but on most social media platforms and other news outlets. And I was going, look, how can I effectively dissect all of this abundance of information, and for me to really capture the signal amongst the noise? And that was the fundamental impetus for me to start Through the Noise, essentially helping you cut through the noise on startups, community, and capital. And that currently takes the form of a newsletter and a podcast done on a weekly basis to really give you that signal in the sea of noise.
Yep. Well, you couldn't have picked a better time to start to, try to create some signal in a noisy world in financial markets than probably you did now. So I'm sure the timing wasn't necessarily planned, but it worked out, I think, pretty well. Let's dive into that a little bit, Alex. I mean, anybody, if you're watching or listening to this podcast somewhere anywhere close to the time that we've recorded this back in May 2022, the markets are just exploding, after years of sort of only one direction, right? And things have really changed. What's going on now? I mean, when you start to kind of look at that kind of that signal, what do you see as being the main driver of what's happening?
Yeah, I mean, looking at it from a high level, right? Look, we are totally in bear market territory now. I think from all-time highs back in Q4 2021, at least in the public market, the S&P's down 18%, the Nasdaq's down almost 30% from highs. And I think looking at some of the contributing factors, we've got surging inflation, rising interest rates, the geopolitical tensions with Ukraine, supply chain bottlenecks, and obviously the persistent effects from COVID-19 coming all the way back from 2020. And I think rewinding that tape one step further, Greg, looking back to March 2020, we saw the Fed starting to inject massive amounts of stimulus in the economy to essentially avoid an economic collapse. We were seeing, I think, smoothed over a quarterly basis. We've seen $900 billion per quarter to households that the Fed's just been injecting into the economy, right? They've cut interest rates from 1.5 to 0. And their balance sheet is just this swollen behemoth, right? It's over nearly 9 billion, which is completely absurd. So this
9 trillion.
Nine
yeah.
trillion.
Wish we were 9 billion. That would be great.
Yeah. I hope so. But I guess from that, we've seen this total dislocation from asset prices to the real economy, right? That the Fed has fundamentally distorted capital markets. So if we now look at, okay, how has this painted the economic picture from that? The Fed's massive stimulus package, cheap money, low rates, combined with this super fast recovery of economic activity, right? It's led to this crazy demand shock for goods, right? So, toilet paper, hand sanitizer, wheat, diapers, baby formula, you name it, right? It's there. Whereas services, on the other hand, that's fundamentally lagged from stay-at-home mandates, because it's really a requirement for in-person businesses. Flipping to the other side of the table, we've got these global supply chains totally constrained, right? We had lockdowns in China, and now coupling that with Russia's invasion of Ukraine, it's just squeezed the commodity market, all the way from oil to wheat. So this positive demand shock coupled with this negative supply shock, it's caused prices to just rocket. And obviously we've seen that firsthand with CPI. It's risen to 8.9%, which is the highest it's been in 40 years, Greg. And that's way, way higher than what the Fed's targeting, 2% inflation. So now the question lies, look, how do we actually overcome this problem? And from that, the primary lever being raising interest rates.
Right.
So I guess just to break that down for some listeners and give a quick, macro one-on-one, when you have a country's economy getting a little bit overheated with, prices getting a bit out of hand, central banks, they use one of their monetary levels by increasing interest rates through a contractionary monetary policy. So this takes the form of an interest rate hike. So they increase interest rates. And essentially what that does is it encourages saving and also reduces spending. So, we see lending activities reduce, and consequently, business activity can fall. Now, from all of that, for the first time in 10 years, the Fed has now raised rates, both in its March and April Federal Open Markets Committee meetings. It's gone up by 0.75%. And now the market's expecting, look, we think we're going to see an additional 2% by the end of the year.
Right.
So look, from all of this, from these contributory factors, the number one catalyst that I see driving this fundamental shift in the economy and this almost collapse in sort of asset prices in the stock market is this market sell-off from a massive increase in the market's expectations for rising future interest rates. So people are going, look, we think future rates are going to just, blow up in the years to come. We are now risk off. We are going to take our money out, and all of a sudden, everything comes tumbling down. So it's quite a crazy phenomenon. And I guess, unveiling the curtains a little bit more, Greg, this concept of leverage is so profound, right? Because even the top investment banks, the top brokerage houses, they don't know how much leverage is in the stock market right now.
Right.
But a good indicator is margin. So, for example, I guess the best way to demonstrate this information asymmetry is Archegos back in March 2021, where they just blew up, right? They wiped out billions of dollars of capital from the markets. So really, margin debt is just the tip of the iceberg when it comes to understanding leverage within the stock market as a whole, right? And when we actually zoom in to margin debt itself, it's fallen. It was at 930 billion, and it's gone all the way down to 773. That's a drop of 17%, which is really just the start of this unwinding. And it's a total bloodbath out there. I think just take some of these very, very well-known names, such as Snapchat, Pinterest, Netflix. They're down 70%, 80%. All the Zillow's down, Zoom's down almost 80%. DoorDash, Peloton's almost down like 90+%. It's complete madness. So it's very analogous to the dot-com bust, only bigger. Because
totally.
If you think about it, a given investor or a given party of investors with a heavy concentration using margin, they're just going to be forced to sell down the margin debt that they borrow from their broker to meet these minimum requirements. And then all of a sudden, when this happens at scale, you're just chucking fuel right on the fire, Greg, and you're just increasing this total selling pressure. And I guess from that, the big takeaway is, look, there's a very important relationship here between stock prices and margin balances. And when you start to really ramp up leverage, it is a leading indicator for where we're going to be seeing stock prices. Not so much the total dollar value of leverage, but it's the sort of the delta change in leverage, right? So coming out of March 2020 with COVID, it was just this vertical wall in leverage being employed by these institutions, by these firms. They were just levering up, right the way to the max, almost this vertical wall, Greg, of margin debt, and it's complete insanity. And now what we're seeing is it's starting to unwind, after this $4.7 trillion money printing mania, it's now starting to come back down. And now we're seeing these effects, these second order effects, third order effects on the private markets, venture capital, and startups in turn.
Yeah. And that's, well, go ahead, Peter. I think you were. I
was just going to say that's a good intro into, something I know that you guys talked about before this call, but is you're a startup, right? And, I may be skipping ahead here, Greg, but you're a private company. Like, how is this affecting me? I'm small, right? There's this misunderstanding sometimes, or maybe this exuberance that they're feeling as a startup person that's saying, hey, I'm just going to muscle through. I'm good. We still have growth. I'm still selling more. Like, this isn't going to affect me. I don't think that's true. I mean, I've personally been through that, and you can ask my family. We definitely got affected by a downturn pretty significantly. Why don't you talk about that? Because that's really, I think, really important for people to understand.
Absolutely. I think let's firstly look at sort of how these private market valuations are stacking up, and then we could perhaps
exactly.
So what? go to the, okay,
Yep.
what sort of frameworks can we implement now to sort of weather the storm and see
Yep.
out the rest of the cycle? So, you know, transitioning from public markets to private markets,
Mhm.
there's a great Substack that I subscribe to at the moment by a guy called Jamin Ball. He does one called Clouded Judgment, and essentially he covers the top SaaS companies right now, and that is essentially the valuation multiple from that is an excellent indicator for VC exits, right? And
Yep.
startup exits. You know, what are we picturing towards? What are we at least heading towards when we realize some sort of event horizon? So, you know, these median multiples, they have come crashing down to, you know, 5x, 6x, with low growth being about 3.5 and high growth being just over 8. So in order to actually justify a unicorn status now of, you know, $1 billion, you would need well over $150 to $170 million of next 12-month revenue just to meet that on a valuation term. So,
and that's at a high growth valuation,
and that's at a high growth value.
Right.
Exactly.
Right.
So
Yeah, exactly.
to give an example, take the work tools platform Notion, right? Which I love. I'm a prolific user of it. I use it to manage a lot of my systems that I employ in my day-to-day life. In October 2021, they raised, I believe it was 275 million on a $10 billion valuation. Right? It's 2021 revenue, I believe. I think this is a bit of a shot in the dark, but I know it was somewhere around the sort of 43 million range. Okay, this is a 230x.
It's not 2 billion. Let's right?
No.
that would justify a $10 billion.
Exactly.
That causes problems, though.
Right.
That does
Significant problems.
Some
Yeah.
significant problems, Peter. So this is a 230x multiple, which is, I guess you could say, a little richer than, you know, than the high growth 8-9x that we're presently seeing in the markets. Sorry, in the market. So
Yeah.
go from that. So what does this mean? Okay, we've got rich valuations in the private markets, public markets, you know, coming crashing down. So what? Well, some of these crossover funds, such as Tiger Global, which I wrote about last month, you know, these private market valuations, they lag public markets, right? So at the end of March, you know, Instacart, the grocery delivery company, they slashed their valuation from, I believe it was just shy of 40 billion all the way down to 24, which is, you know, that's ridiculous. That's almost like 40%. And now the question lies, okay, how are these other companies going to adapt to these prevailing market conditions, right? So I think these valuations will continue to come down. Deal sizes will continue to fall back from the highs of the, you know, euphoria of 2020, 2021.
Yep.
And a big point on that is, you know, these high growth, specifically tech startups, they're very sensitive to increases in discount rates. Essentially, discount rate is just the interest rate you use to calculate the present value of any firm's future cash flows, right? So these high growth startups, they're very, very high discount rates because there's, you know, quite a significant level of risk you incur when you go to invest in one of these companies. So back to my point previously, look, crossover funds such as Tiger, they are, you know, let's take Tiger's most recent fund, Private Investment Partners 15. They closed a $12.7 billion fund, and that's almost completely invested, right? That was, you know, all the way back in March, but they're almost completely allocated. So, you know, that speed was still there.
Fast. Yeah.
Very fast, but, you know, these comps have been inflated and investing timelines were massively compressed back in this period. But I think what we're going to see now is them start to elongate once more, and things are going to go that little bit slower, a little bit smoother, because people are taking that step back and going, look, does your business really command the multiple that you're raising on? What's your operational efficiency like? What are the numbers like? And, you know, like is it a good sound business? Are you going to really weather the storm, stand the
Yeah.
test of time? You know,
Yeah, and it goes back to,
that's the question.
Does
Yeah.
it go back to like fundamentals, like
Mhm.
like where are you, like from a profitability standpoint, where are we, like, and things like that. So this is stuff that Greg and I talk about a lot. It's like, how does that change your ability to, so if you're raising now, how does that change your ability to raise, and what should you be doing, right?
Yeah.
Yeah.
Yeah, for sure. I mean, you start to bring this down, right? You go from public markets to like large, that Tiger Global brand of PE, right? So I mean, it's private market, but it emulates, and I think SoftBank is like this, and the Vision Fund and stuff like that. I mean, they really do emulate a lot of the public market dynamics and things like that. I think where this gets really interesting, Alex, is like when you take it down to when you take it down to sort of the more, I would sort of either call it late stage VC or growth PE, depending on how you want to define it, where you look at the valuations that there's been so much competition, there's been so much capital coming into those companies, into those funds, so much competition for deals. The premiums that they've been paying are just extraordinary, and they're levered, right? And that's, I think, where this gets really, depending on your perspective, either interesting or scary, right? When you start to look at how do you start to think about unwinding that, right? Because you've got this entire category of company that is out there right now that's probably in that, call it 20 million ARR to 100 million ARR.
Yep.
That is wildly inflated in terms of their valuation, right?
Yeah.
But that sort of party deal mentality that it's fine, we're just going to trade up to the next PE and the next PE and the next PE.
Yeah.
It's gone, right?
Yeah.
And what do you do, right? If you're you're a CEO of one of those companies and you're valued at, you're doing 40 million in revenue, valued at 600 million, what do you do?
Exactly. Yeah, it's a really interesting question. Look, how can this group of startups navigate the downturn that we're seeing? Right. I think the big one, at least, is to reevaluate your valuation. Okay, look,
right,
what did you raise your previous round at? And very much consider, look, it can take up to 6 months to see, look, what's happening in the public markets to trickle down to venture funding. So look at your sector, where you're operating in, and calculate the ARR or revenue that you need to go to at least 12 months of runway, at least 12, I would say 12, 18 months ideally, because less than this figure, and what you're doing is you're giving a signal to the fund or partners that you're wanting to raise from next that you're unattractive, especially within this climate. You're going, look, I am not prudent, I'm not careful of managing my cash position, managing my people and my business. And I can demonstrate to you effectively that I can manage this well. I can demonstrate to you that, look, I have this runway. We're looking for a little bit more cash to expand operations. Show me the money, so to speak. So it's really important that you can demonstrate that. And I guess coming from that, it's very important to control your burn rate to ensure efficient growth. And zooming in a little bit more, we can look at your burn multiple, which is essentially your cash burned over the net ARR added. So, for example, look, if company A burns 20 million to add $10 million of ARR, look, it would have a burn multiple of 2x. And I think this is more relevant than, say, efficiency multiples at this time, such as, say, LTV over CAC, because your burn multiple, it at least takes into account business functions across the entire company.
Right.
Not just sales, not just marketing. It's more of a holistic view as to how you're going. So I think that's another really, really important one, Greg.
Yeah. There's been a lot that's been written about burn multiple lately. And, I think I know David Sachs has done a lot of writing about this as well. And, I think it is a really important metric, but I think the thing that I would always caution a CEO of a company to do is if you're expecting though your growth, what that presumes is that your growth rate is going to be somewhat static, right? Or it's going to stay the same, and you're going to continue. And I think one of the things you really need to do is be looking at that growth rate and start to anticipate the decline in that growth rate, right? So if you're going to look at a burn multiple to kind of almost take a little bit of a discount on that growth to be able to say, okay, but even though my burn multiple today might be 1.5, if the market slows down, if our sales slow down, which you have to almost anticipate they will, I could find myself creeping up north of 2 or more really quickly. So I think it's, you've got to be one of the things that's interesting to me, and I've sort of joked about this a couple of times recently with people, is like, I think I've now turned into the most depressing man on Twitter. And the reason is because I keep writing about like, get ready, just like get prepared, right? Because when this stuff happens, this trickle down effect of the public markets get wild, that trickles down to the private markets, that trickles down to VC, that trickles down to private companies. And when that happens, it gets bloody so fast. I mean, that tide turns so fast that if you're a CEO today, you've got to be thinking about what your strategy is. You've got to be thinking about doing exactly what you just said. How do I get 12 to 18 months? I wrote about 12 to 18 months, and I've said 18 to 24. I get so many terrible comments, just flamed so many times when I say this. People are like, you don't need it. It's fear mongering and all this stuff. It's just unbelievable when it happens. And there's just not, unless you're over 40, you haven't lived through this, right? It's been 13 years since we had a downturn. We had the COVID blip, but unless you've lived through, you lived through a recession, and Peter and I have both done it in 2001 and then 2008. And I lost the company in 2001.
And I lost the company in 2008.
Right.
It was horrible.
Together, we can't manage to make it through a recession. It's unbelievable. Individually, we're okay. Together, it's a nightmare. But you really, it just, the pace that it happens is so fast, right? And getting that cash on hand and understanding that you are not immune to this kind of gyration, these sort of wild vibrations that occur.
Yeah.
I'd say the biggest warning is the company I lost, we were growing at 220% year over year. It was almost out of control growth. Like we were trying to catch up with the funding to support it and slow it down. And then we turned everything off because we ran out of, the funding was like gone. It's like being in a desert and all of a sudden there's no water. And you're like, wow, this is crazy. And everyone's congratulating us on how much we're growing. And I'm like, that's not good. This is not good.
Thank you. Can I mail you my keys, please?
Yeah. We ran out of cash in January of 2009, and it's just like, it was awful. 190% growth that year, right into trouble. Like it was like now we have no cash, and that's not fun.
Well, the sad irony in situations like that, and I went through a very similar one in 2001, where we had gone literally between 99 and 2001, we went from 0 to 8 million in revenue. This was a services business. And we started the year right around 8 million in revenue. And by the end of the year, we were out of business. We were astronomical growth, right? And I think what people don't necessarily understand, that if you don't have a real sort of firm grasp of your financials, what they don't understand is the faster you are growing, the more exposed actually you are.
Yeah.
You can't outgrow this, right? Unless you're really profitable. But startups that are living on venture funding and things like that, on outside funding, you cannot outgrow this, right? As a matter of fact, it will accelerate the issues, not solve them.
Yeah. It's so true. And
go on, Greg.
No, I was going to say, so, there's been so many changes, right? And I think one of the big things when you start to see this is, because it has been so long, there has been this kind of structural, there's been this structure that has been put in place, right? With these mega PEs, with super large VCs with, going earlier and earlier stage. What do you see, Alex, as like, what does VC look like when all of this shakes out? Is it different than it has been, and in what ways?
Yeah, that's a really excellent question. I think, casting at least the current significant downturn to aside just for a second, before this, very significant downturn, the face of VC was changing significantly. People were forming much greater affinity with individuals over institutions. And I think in large part, this has something to do with the distrust that has been developed with the mainstream media through time. Traditionally we had the mainstream media, newspaper, radio, television, internet, and so forth. But now it's very, very relevant that they have an agenda. They want to make money through clicks, through views, versus now people want to go direct to the source. They want to go direct to the founder, the firm, and get their news from the source. And this has no greater effect than within VC. So the rise of solo GPs, such as Patty McCormick, Harry Stebbings, my fellow Londoner, even Sahil Bloom's recently raised a fund at the start of this year.
Me,
Mr. Greg Moran, of course, can't forget that. And it's individuals are now the brands, distribution is the game, and this shift in venture to a very significant change in the whole brand building process, and I guess this ties in quite nicely with the idea of building a community, building online, building community first, where instead of going through, say, a traditional PR mechanism of announcing a new deal, we have Chamath Palihapitiya going direct to his fans on Twitter, going, "Oh, just invested in a new SPAC," or whatever it might be. But it's maybe not so much in the SPAC sense, but especially within early stage venture, individuals doing a quick Loom video or a quick voiceover or a quick collaboration with some of the other co-investors. You as the consumer, you as the person on the other end of that transaction who's going to be participating in the betterment of that portfolio company, you're getting a real flavor, a real understanding of what's going on behind the scenes. Yeah. And okay, yeah, I like this guy because I've been following him on Twitter for the last 2 years. I know he's believable. He's invested in this company. I think I might check it out. That has far greater meaning and credibility versus, say, a traditional PR firm intermediating the process for you. And that personal touch often being lost.
Yeah, that is such a great point. I mean, I think it's really interesting. I've never thought about that linkage to kind of the media and people's feelings toward the media before, but I think it makes complete sense, right? And when you look at that sort of rise of the solo VC, and in my case, I'm not literally a solo. I do have a couple partners, but I mean, we're it, right? We're the entire firm. And you look at that, it really is about distribution, right? It really is about how can you help to sort of create the company that you're investing in. And I think, when you compare that, one of the biggest challenges, I used to wrestle with this constantly, and this would blow me away, that I had a number of investors in my previous business, and I had no idea who the LPs were. I had no idea. There were SPVs investing in my last company that I had no idea who was in the SPV. Yeah. I'll never forget this as long as I live. The greatest example of this, our largest client, I don't want to give this, our largest client was one of the largest airlines in the world. They represented not a meaningful, probably 3-4 points in our revenue. Yep. And they were on the rocks, and we were having a hard time retaining them. What I did not know is that their chairman was one of our investors, because this wall existed, right? I found out after I lost the client that the chairman of the company was one of my investors. I ended up finding out, going to lunch with him, telling him the story, and he said, "Why didn't you call me?" And I said, "I didn't know who you were." I had no idea. I mean, I knew who he was. Everybody would know who this guy is, but I had no idea that he was actually one of our investors, right? Because this wall existed. And I think one of the things that we've really sought to do is kind of break down that wall and allow our LPs and allow people who want to get involved and want to have visibility to make that real personal connection so that we can help grow a business together.
Yeah, totally agree. Totally. And I think, the point there being that let's maintain control over our message.
Right.
And I think when you look at traditional firms, they have neither brand nor distribution, and back to that point, specifically with journalism, in order for journalism to work, you need all these group of journalists to buy into this certain code, this certain ethos, this certain behavior. And in turn, it skews objectivity, right?
Right.
It's like I said, it's all click generation, and it sort of hides the real truth.
Yeah.
Versus now, when we do get to keep control of our message and avoid uncertain circumstances such as that, Greg, it's a much nicer, less intermediated way to get your point across.
Yeah.
And at least the internet, it has just commoditized the reporting of facts.
Yeah.
And I think, to my point previously with these solo GPs going direct, now, if I'm raising a new fund, if I'm scouting for talent, if I'm looking for recommendations, all of these are just a tweet away, a blog away to audiences that are, 100K plus deep.
Right.
It's crazy how deep and connected this ecosystem actually is.
Yeah.
And look, now individuals, we are the truth seekers. Mainstream media, perhaps click seekers. So the bottom line is that we want to form affinity with people. Platforms, Twitter, I think, is such a wonderful platform to do that, and we'll see what Elon does with the whole thing in regards to the takeover process and also with regards to free speech. But the removal of these traditional media houses, it does allow everything to be taken at face value, because individuals can now arrive at the truth through a more efficient marketplace of ideas.
Right.
And that's the big one. It's going from intermediated to direct, less speech to more speech, and we have this greater abundance of ideas, hence the need to cut through the noise.
Well, that's a perfect way to kind of round it up, Alex. And we're getting to the last couple minutes. So tell us, before we wrap up, what's the plan? What do you're a founder yourself, you're building your sort of media, your own media brand, if I want to call it that, or your sort of curation brand, or however you want to describe that. But what is that kind of long-term strategy for you as you see it today? What should we be watching out for?
Yeah, this is such a big, deep question, but I always love to sink my teeth into this, Greg. So really, what I'm doing at the moment is building something in the intersection of media and investing, right? I think having distribution on the first hand is at least my go-to strategy, because I know, as I said before, having a deep connected audience who knows, likes, and trusts you in a space online where you're giving so much value for free over a long period of time that the bank of goodwill that you amass is not even funny. And we've seen that with prime examples of some prolific creators on Twitter now going out to form their own venture funds just because they have the spear point of distribution in the grasp of their two hands, and they can go to their audience and pretty much source top talent, get access to incredible deals, and find a caliber of information and people that would otherwise not have been accessible to. So I would love to point myself in that direction with the ideas that I'm talking about through the newsletter, with the conversations that I'm having with the founders and VCs on my podcast, and really, arrive at the truth, arrive at that marketplace of distribution, whilst also having the ability to invest in some of these early stage startups that are foundationally unlocking a lot of economic opportunity over the next 10, 20, 30 years.
Yep. Well, Alex, you're doing a great job doing it. Been following the story for
Absolutely.
a while, and love watching it. And I think so. Through the Noise is the podcast. Through the Noise is the newsletter. You find Alex. I want to get this right, because Alex has this. One of the worst problems I've seen with like Twitter people stealing his handle, but it's the Alex Bex on Twitter.
Yeah, I think it's something that I hope Elon fixes. Getting rid of the bots, getting rid of the trolls. But yeah, we'll see.
That's right. Alex has had a bit of a bot problem of late, but the Alex Bank. So Alex, awesome to have you on the show. Really appreciate it. A lot of fun. I love listening to kind of the simplicity, the elegance that you talk about the financial markets with. So it really is really great to have you here. So thanks for joining us, and we'll definitely be having you back again once we start to sort out the next phase of this craziness that's going on.
We definitely will. Thank you so much for coming.
Guys,
it's awesome.
Greg, Peter, it's been a real pleasure doing this one. Thank you so much for having me. And listen, I wish you nothing but success with the Founders Journey podcast, Founders Journey newsletter, and everything in between. I know it's going to rock.
Appreciate it, Alex. Thanks.
You. Cheers. Bye-bye.
Cheers. So that was a good one, Peter. What did you take away?
He was great. I mean, if you're a founder and you're listening to this, it started out sounding like this, CNBC narrative of what's going on in the market, but I think it was a little deeper than that. But then it all kept coming back to, wait a minute, this is affecting you, and then connecting the dots between the public market and the private market and where companies sit today is super important. And I just think it's invaluable for people to think about this now. And I know you mentioned that people were, giving you trouble and saying, hey, the sky is falling, but I would have liked some heads up. And when my sky was falling and I didn't know it, we probably would have done some things differently. We would have moved faster in different areas. I don't know what you think, but I think it's super important to be super attentive to what's going on. It's one of your jobs as the CEO of any company. Yeah, no, it's a great point. Alex is a brilliant guy, and writes with a lot of clarity around. I mean, it's he calls his business called Through the Noise, and this podcast and newsletter, but he does an incredible job of just writing with and speaking with a lot of clarity about what's going on. But that it is a really big macro topic. But you're absolutely right. If you're the CEO and you're running a company, you have to understand what is out there. And I've been getting, a lot of kind of negative stuff coming back, not a ton, but I mean, enough to notice where, I think there's always this moment where people want to put their head in the sand, right? And I've been writing a lot about, here's how you prepare, right? Here are the things you need to be thinking about. Maybe I'm wrong. Nobody knows where this is. What is the downside? What is the downside? Maybe your growth isn't if you're kind of adjusting if you're adjusting to get this 18-month runway, it's probably going to affect your growth. Mm-hmm. But you're also more fiscally sound, right? You've just shored up your business. You became more, investable, really. Yeah. And that's kind of what, Alex was talking about. You are more investable. That message that you're giving is, I'm a professional CEO. I know what I'm doing. Even if this is your first time, it doesn't mean you can't be that person, right? You can't get prepared and then you're more investable, right? It's those conversations where it's the old conversation was how much AR you have, where are you? The new conversation is well, here's how much AR, but also I have runway. And all of this is doing is just helping shore up that what I've already done that's good, right? And that's a better conversation. If I came to you as an investor and said, hey, here's where we're at, you're like, wow, this deal looks a lot better than the one that's like, yep, we're running out of money, and but we still have like this high growth. We're good.
Alex talked about that that ratio, the burn multiple metric. And I think it's a really good, I think it's going to become increasingly important. It's important right now, and it's going to become increasingly important. I know just from the VC side, I mean, I look at this all the time, right? And I'm still continually shocked. I mean, when I talk to a CEO or a founder who, is saying, well, no, we're fine. We don't need to do this because, I've got enough cash to get me through the end of the year. So I'm okay. But what the fundamental problem, the end of the year sounds like a long time away. The problem is what's going to happen is fundraising cycles are going to continue to elongate, right? They're going to get really long, and they're going to be investing in a risk-off environment, right? Which is, we're going to be investing when there's some inherent sustainability. Company doesn't have to be profitable, but they can't be burning, at absurd multiples. And it's probably going to take you 6 or more months to raise that round, because what a VC is going to want to do, or what any kind of investor is going to want to do, is track you for a little while, right? And see, how do you manage in this environment? And to what extent is this kind of environment going to impact your business? And I think, that's the thing. I mean, I think that burn multiple is a great metric. I think, always focusing in any economic environment, always focusing on the unit economics of the business to understand what's your sales efficiency. Are you selling profitably? Or are you selling unprofitably? What's going to happen in an environment like this is the ones who are selling unprofitably are going to be the first ones to get shook out. Yeah.
And the pressure comes down, and that the due diligence is going to look at that, right? You're going to, that's one of the things that would be the first thing to look at and see, okay, where is this sustainable and at what rate?
Right.
Or wow, they have a really good model. They just need to kind of extend it, and then they'll continue to be good.
I think there's two really important concepts, right? One is sustainability and one is investability, like you just said. And they're sometimes they're two different things, right? Where you may have to actually become almost uninvestable for a period of time to become sustainable. Right. Because sustainability is the ultimate thing. Like if you don't have a business left in a few months to invest in, investability doesn't matter. Right. So
I have no idea what you're talking about. Well, that didn't happen to me at all. Too.
Yeah. I mean, look, same thing happened to me. Right. And it's crazy. Right. But that happened to, at least in my case, and I think in your case too. I mean, ultimately what that came down to was cash. Right. I mean, it just simply came down to cash, not having the runway for however we both got there, and we both got there different ways. Right. I got there because I was spending like a drunken, insane sailor, and, we were just plowing everything into growth, and we got taken out. We didn't have the cash, and you had, different circumstances with creditors and things like that. But
but we ran out of cash. So,
right. I mean, that's what it comes down to.
In the water.
Right. It's just making sure that you've got that liquidity that can get you through an extended period of time. Right. If you do, you got nothing to worry about. And you can use it as an opportunity to really, you're going to come out of this like you just said, you're going to come out of this a better business.
Absolutely. I mean, that ratio is really cool because that's going to tell you kind of where you're at.
Yep.
And if you affect that in a positive way for yourself, you're basically creating more sustainability in your business.
Totally.
Even if you're burning cash.
Right. And the side benefit is you'll be less reliant on VCs going forward, right? Keep some of that equity in your pocket.
Yeah, exactly.
All right. Cool. So thanks, Peter. Great. Another fun edition here of the Founder's Journey. And we will be back soon. These are released every Friday-ish. Although I think last one came out on a Saturday, but every Friday-ish. So if you haven't subscribed, make sure you hit the subscribe button at the end of this.
Great guest. We have another really good guest coming up next week. So can't wait for you guys to hear that.
Absolutely. All right. Thanks for joining the Founder's Journey podcast.